Got the goal of buying a house but have no idea where to start? Well, if you think you're 1 year or more away from purchasing your first home, here's exactly what I recommend to do to prepare. Hello everyone, my name is Cameron Stevens, the entertainment industry's real estate agent and the owner of Stevens Real Estate, a real estate experience tailored to the creative client. Okay, so you've been browsing Zillow for a few months and you think, wow, some of these homes are ones that I'd actually love to live in. And then you think, wait a minute, I haven't the faintest idea of how to make that happen. Well, guess what? That's most people. So the first thing is, do not worry. This process might seem daunting and complicated, but I'm gonna demystify it for you. I'm gonna tell you exactly how to prepare, and then when we do get to the complicated stuff, I'll be there to help advise until you get those keys in hand. But before we get to the first step, let's talk a little bit about timing. So interest rates fluctuate. The market changes, but I'm going to give you my advice that will not change no matter what type of market we're in. The best time to buy a house is simple. When the best time is for you, personally, in your life. The only two mistakes you can make are purchasing a house that you can't really afford out of fear because you're scared of missing out, or you're trying to wait for some time, some movement, some change in the market that may never happen. Therefore, my philosophy on when you should buy is this: time in the market always beats timing the market. The reality is we don't know where the market is going to go. If interest rates go up, it is likely that prices will plateau or possibly dip. But even if prices do go down, then your purchasing power went down too with those rise in interest rates. So you're at a wash. And if you buy at higher interest rates and interest rates go down, well, great. You just refinance and you keep all of the equity that you've been building up by purchasing that you would have missed out on by waiting. And if you buy a house that you love with a fixed rate mortgage and payments that you can comfortably afford, it doesn't matter at all what happens to the housing market until you decide to sell. That means as soon as you're comfortable, buy what financially fits you and start paying into an asset now instead of paying rent. Okay, so with that out of the way, you know that buying a home is a smart financial decision, but you're at least a year, maybe even more, out from buying. What do you do to prepare? The first thing is to get your finances in order, making sure that all aspects of your finances, including your down payment money, your credit score, any recurring debt, are properly taken care of and any potential problems are addressed before you move towards a loan approval. Let's talk down payment. I advise my clients to have at least 10% down to purchase a home in Los Angeles. Now, you will incur mortgage insurance on any payment that's less than 20%, but oftentimes clients have some difficulty saving up the entire 20% for a home that they really want. And that's okay as long as you're making enough money to afford the higher monthly payments that a lower down payment carries. Remember, if you put 10% down or even 15% down, as soon as you've made enough payments that the equity in your home is now 20%, you can make that mortgage insurance go away. So don't worry, it doesn't last forever. Now, how about that monthly payment? Well, your monthly housing payment is different than when you were paying rent. Then, when you're paying rent, it's one check you wrote, one single sum that, as long as you paid it each month, you're good. Now you have various costs that together are considered your housing payment. And that would be your mortgage payment, property taxes, insurance, and any HOA payments if you purchase a condo or a townhome. Your mortgage payment on a fixed interest loan is exactly the same for the entire life of the loan. 30 years if you happen to get a 30-year fixed loan. That payment has principal, which is the money that pays off the loan and you get to keep. That's equity that you build up. And interest, and that's the cost to borrow the money. Then you have property taxes, which are due in 2 lump sums twice a year, December and April. Now, you can choose to prepay these into an escrow account so that you don't accidentally wind up at these times and not have enough money set aside to pay them. Or you can just go online and pay at each of these 2 times in those 2 lump sums. Finally, home insurance. Now, don't let that scare you. Home insurance really shouldn't be more than about $100 a month. Probably much less than that if you're in a condo or a townhome, because the HOA will actually cover a certain portion of that insurance under their umbrella policy. So with all of those things considered, the rule of thumb is to keep your housing payment no more than 40% of your gross income. So simply take what you make in a year, divide that by 12, and before you have taxes and other things taken out, you shouldn't be spending more than 40% of that money on your overall housing payment. Now, some folks stretch that to 50% if they know they have a raise or a promotion coming down the line, or one partner is returning to the workforce, but that really should only be temporary, because remember, we do not want to be house rich and life poor. A lot of folks think that the right way to approach housing numbers is to find out what purchase price you should look at. I actually find that it's far easier to look at the amount of money that you don't wish to exceed on a housing payment per month, and then back that number out into a purchase price, because various aspects of the numbers on a loan can be wiggled around. But if you know that number you don't want to exceed very solidly in your mind, then you know you're going to end up with a home that you are comfortable with. Okay, we've looked at down payment numbers and the monthly payment. Now let's look at credit scores. So if you don't know your credit score right now, hit pause on this video and check your credit score. Almost all major banks offer it as a free service. There are many online that are free as well. Just type in free credit report and hit search and you'll find something. And we're back. Okay, so chances are you got what's called your FICO score. And this is just one of the 3 credit bureaus, but don't worry, it's good enough to work off of for now. The first major break in loan prices is for a score of at least 720. So that's where the big savings come, and that should be your goal if you aren't quite there yet. There is another break at 740, though not as big as the break at 720, but it's still a good one. And anything above 740 is basically the same. It means you've got excellent credit and lenders are going to be happy to lend to you. Now, if you're not at 720, that's something to fix as soon as possible. Now, usually you can pay off some debt like a credit card to boost it, or if you don't have enough credit history built up, you can actually become an authorized user on a family member's credit card to help build that history faster. And if you're far enough in advance from purchasing a home, you can call your credit card companies and ask for an increase in your credit limit, or even open a new credit card and just put a couple charges on it a month and pay it off in full. In fact, everyone that listens to this video can probably benefit from calling their banks on all their credit cards right now and ask for between a $5,000 and a $10,000 increase. Honestly, they're very likely to give it to you, and your utilization rate, which is how much you spend against how much credit they extend to you, will immediately go down. If these aren't enough or aren't good options for you, then schedule a consultation with me. I've worked with plenty of people to get their credit scores up, but it can take as long as 6 months, which is why it's a great idea to start working on that immediately. I have access to a free program that gives us everything we need to do to get the credit score up, whether that be just a few points or really fixing a pretty low credit score. We can do it all, and it's free to do. Finally, we have your debt to income ratio. That's another big thing lenders look for. So your debt to income ratio is all of your monthly debt payments divided by your gross monthly income. This number is one way that lenders measure your ability to manage the monthly payments, to repay the money that you plan to borrow. And it's a good number to start calculating now, because the magic threshold that we're trying to hit here is 43% or less. The major recurring types of payments are the mortgage payment, any car payments, child support, student loans, minimum credit card payments on unpaid balances. These are things that count towards that. That's why taking a look early at some of these things and possibly paying down things like a credit card or some remaining student loans can have a massive impact on your financing ability. For example, I recently had a client that had a car payment that she could comfortably afford, but having that recurring payment pushed her debt to income ratio higher than the house purchase price level that she wanted. So she had the cash to go ahead and just pay off the car. And think about this. That $500 toward a car could now go directly towards what she qualified for on a housing payment. And that extra $500 a month qualified her for over $100,000 extra in purchase price. That's a big change. So if you've been following closely, you'll see a few trends. Save diligently, know your credit score, and pay down debt. Now, here are a couple of miscellaneous tips to help you achieve all of those things. Instead of saving in the traditional sense, pay yourself from your earnings and put the rest into savings. Think of yourself as an employee of your own corporation. So for example, at Cameron Stevens Incorporated, I make a certain amount of money total, with which I invest a portion, I pay recurring and living expenses, and only then do I pay Cameron Stevens, the individual. This mindset can completely change the way that you think about saving. Knowledge is power, so use a budgeting tool. Start by taking your credit card statements from the past year, all 12 months of them, and seeing exactly what your monthly expenses are. Your goal is to intimately understand what the average is and how much you're truly spending per month and per year. And if you need more help than that, a program like Mint is free, and it's great to see what your expenses are by categorizing them. Then, if you're serious about buying a home, consider cutting back on some things for a little while, like eating out or vacations, and also look at canceling or consolidating those automatic subscriptions and memberships. I know I have been very guilty of having Netflix, Hulu, Disney Plus, HBO, and then a Spotify account on top of all of that. It might be time to cancel any subscriptions that you're not using regularly. Finally, try the 30-day rule. Oftentimes, if I'm considering buying something, I'll put it in my cart and I let it sit there for 30 days. And then, if I still really feel like I would want it in my life after that time, fantastic, I'll buy it. But if not, and most of the time it's a no, then I have successfully avoided an impulse purchase. Save like a pro. Remember, most big banks are the absolute worst place to keep money in a savings account, after physical cash, that is, you're stuffing under your mattress. Instead, use a high-yield savings account like Ally Bank that I use, or Marcus by Goldman Sachs. Now, the numbers they're paying you might not look especially high, but they are actually paying you somewhere between 10 and 100 times more on interest for your money than, say, Bank of America or Wells Fargo. If you're more than 2 years out, I highly recommend getting a far better return on the money you're saving by being invested in index funds. Now, I use Vanguard, and they have some pretty incredible low-cost index funds that mimic the S&P 500, like VFIAX. Charles Schwab has a great low-cost index fund that mimics the S&P 500 as well. Now, yes, sometimes the market goes through periods of volatility, but go to most domestic index funds and zoom way out, and you're looking at an upward trend. Any money that's not needed for over a year should be here in case you have to stomach a downturn of any sort. Remember, we're not buying individual stocks here. We're buying index funds that are well diversified, and you'll be just fine over time, and you'll be loving the return you're getting. Oh, and don't look at these every day. Just invest the money, leave it. No matter what you hear on the daily financial news, just leave it alone. Depending on the amount of your savings, this could be tens of thousands of dollars you're able to add to your down payment. And then, when you actually get closer to buying, you can convert a portion of the investments to your high-yield savings account, so they're nice and protected and liquid as well. Here's another great one. Do you get a pretty substantial tax refund each year? Now, that might feel good at the time, but that's money that you're giving to Uncle Sam that you didn't actually have to, and it made a 0% return while they kept it. You might want to take a look at adjusting your deductions so that you're closer to no refund, or even a very small tax bill, so you can get more money each paycheck, and that can go into investments that are actually earning money. Now is the time to talk to a real estate agent. I love financial fitness, if you can't tell, and I love helping people prepare to take the step towards buying a home. But I realize that this advice can be kind of general. I will often put together personalized financial plans and tips for clients, and even though I'm not a financial advisor, I do have straightforward and practical advice to draw on and share. The last step is to talk to a lender. Now, this just builds off of the relationship that you develop with a real estate agent, because the lender can take a hard look at your financial documents like your tax returns and pay stubs and help give you more financial advice on how to maximize your credit score or improve your debt to income ratio. The lender is that last final step, as they are the ones issuing you your pre-approval, which is a signed commitment to lend you the money to purchase your first home. Okay, there you have it. Thanks so much for watching. I hope you learned a whole lot about preparing to buy your first home, especially if you're a year or more out from doing so. The best parting advice I can give is to start preparing now, including starting that relationship with an agent like myself early. At Stevens Real Estate, we specialize in working with creative professionals, entrepreneurs, and especially people in the entertainment industry, because I spent 7 years of my life working in animation and visual effects. That's why I designed Stevens Real Estate to be tailored to the creative client. I also designed a few value-adding programs for both buyers and sellers that no one else is offering. For buyers, you get all of your inspections paid for, no questions asked. I even have lenders that specialize in working with folks in the entertainment industry, even if you're freelance. Sellers, we maximize the price of your most valuable asset by giving you fresh paint, new floors, updated landscaping, and full staging at no cost to you. So if you like my energy and personality and you think my expertise and the programs that I offer would be beneficial to you, it is never too early to get the conversation started. Additionally, I have a fantastic referral program. So if you know someone that would benefit from connecting with me, I'd absolutely love an introduction. Thanks again for watching, and at the end of this video, there will be a QR code. You can scan it. It'll take you directly to my website, or there'll be a link down there somewhere where you can click to learn more.